very interesting times for index funds because many people thought last year would be a very bad year for indexing, but indexing actually both in bull markets and bear markets has proven its due now over 3 to 4 decades. There's a reason why the majority of the largest pension funds in the world are still using indexing as a core for their portfolios. Hopefully you can see the slide, Eugene. I'll just doing that. I just wanted to thank many of your colleagues and also advisors on this call for their support over the last year. We did the product with BCI less than a year ago, and it's already raised around R1 billion. So it's one of the larger global equity index funds. We're tracking the MSCI World, which has got over 1,600 shares. And the MSCI World is actually a very steady, broad index. Just to give you a brief background on it, it's a core global building block for most pension funds. Most institutional investors, certainly in the US where I am here in California, are using indexing as a core part of their global blend. So it's a collaborative, blended approach. We're not here to say that active managers don't do the best job. There are many of my friends are active managers. There are a lot of smart active managers out there. The way it's generally used here in the US and even in Europe is it's a blend. We find it's a collaborative approach between indexing, passive and active. And the indexing typically is the low cost core. It helps average down the overall cost of the portfolio. I'll show you figures coming up that 80 to 90% of most active fund managers are not consistent enough to outperform an index like the S&P 500 or the MSCI World over most 5 to 10 year periods. And that's the reason why indexing, even last year, beat the majority of active fund managers and actually had net positive inflows last year, according to Morningstar, when the active side of the business actually again had contracted. Over the last 10 years, we've seen a contraction in active fund management in terms of size and market share and a growth in indexing. So the low cost I'm referring to is a TER in the 37 basis point area. It helps bring down the average cost. And really the issue with indexing is it's a diversified core because it typically is 10 times as many shares than a normal global equity manager would have. If you think most global equity managers have between 30 to 40, maybe 60 shares, the MSCI I just referred to has over 1,600 shares. The US is the largest slice of that. So perhaps we can go on to the next slide. But the reason indexing is working is partly due to costs. A lot of the active fund managers overseas, the average fee out here is about 65 to 70 basis points. I know in South Africa it's more expensive. That hurdle rate, Eugene, is very difficult for them to overcome. And obviously this whole issue of value versus growth and underweighting, overweighting different regions is incredibly difficult, even for the smartest minds. The MSCI World, just to summarize, has all developed markets. So we're talking about the US being the largest constituent, but also Europe and the Asia Pacific region. And those are the key 20 countries essentially that make up the MSCI World. This is excluding emerging markets. So it's just developing markets. And we'll go on to the next couple of slides. I wanted to just show the relative consistency and also just the lack of volatility that you'll see in MSCI World in yellow against its sister, the minimum volatility MSCI, basically going back to 2007, 2008, all the way through to last year in US dollars. Even when the downturns came in 08 and during COVID, the recoveries were quite quick. And it's benefited from basically global diversification. But I would also say having 1,650 shares provides a balance. We don't have this narrowness of having our top 10 stocks representing 20, 30% of the portfolio. MSCI index and most index products, the largest holding typically is 2.5%, maybe 3% maximum. So you don't have this over concentration of the FANGs or of just a couple of large stocks. Thanks, Eugene. We'll go on to the next one. And I think the cost is really the reason why you see these numbers. So if we look at the global MSCI World in blue there, and we go to the first half of 2022, and we see that the percentage of active fund managers, according to Morningstar, Only 31% of active fund managers beat the MSCI. That was in the first half of last year. The latest numbers just came out. Again, a majority did not beat the MSCI World, and nor did a majority beat the S&P 500. And then go over 5 years and over 10 years, the numbers get even more difficult for the average active manager. Essentially, 3/4 of active managers are underperforming. So it's trying to find a needle in a haystack. Certainly, certain years there are significantly clever active managers, but the challenge is to have that consistency. Very few of them over 3 to 5 years, and then going over to 10 years are consistently beating an MSCI type index. Again, this is a global equity index. It's typically used as the core building block for most, I would say, sovereign wealth funds, large pension funds, and many of the largest institutional investors globally, who will use both a combination of active and passive. So I keep saying to many of our clients, don't throw the baby out with the bathwater. It's a blend of both active and passive, and we remain friends with many very smart active managers. There's room for everybody. We'll go on to the next one. I just wanted to show the South African underperformance of South African fund managers. It's partly due to their higher costs and this higher hurdle rate that I referred to a bit earlier. If you look at the part that's circled in red there under global equity, these are South African fund managers underperforming a global index. It's essentially showing over 3 years, 5 years, and 10 years that close to 90% plus, certainly over 10 years and 5 years in the green and the red, have had a very, very tough time outperforming a global equity index. So I'm going to go to the very next slide and show you the numbers behind that. We're actually looking, in this case, at very similar to the MSCI World. It's called the S&P Global 1200. So MSCI World's a bit broad. It's got 1,650. This has got 1,200. Over both 5 and 10 year periods, in the yellow there, you'll see 96.5% of South African fund managers on the global equity side failed to beat the S&P Global 1200. For us, this is really a function of the difficulty of costs that they're incurring, essentially giving an index fund manager almost a 1% head start at the beginning of each year. And again, also the diversification that we benefit from. I'll move on to the next one. The reason I've put this in, Eugene, with the orange there with the S&P 500 is because the MSCI World includes the whole S&P 500. In fact, the US component at the moment is about 65% of the MSCI World. We're not that concerned about the PE ratio on the MSCI World at the moment. It's about 17 times earnings, so it's not excessive by historical methods. But this is just comparing the JSE all share to the S&P 500 in Rand terms. And I guess the point is the market has come down, certainly last year. We see it as a buying opportunity. Our investors are obviously long-term. We're not trying to time markets, and we don't bet against the US. The US has steadily grown in the MSCI World from about a 50% weighting, I'm going back 20 years, to today being just over 65%. And that's based on market cap. And we obviously, the S&P 500 on its own is very difficult to outperform. In fact, I'll show you some numbers that US fund managers themselves, the vast majority, fail miserably every year to beat the S&P 500. And we'll get to that in a moment. This is just summarizing actually how US fund managers who have, on average, much lower active fees, around 65 basis points for their global funds. You'll see in yellow there that the 10-year column, essentially 90.5% of US fund managers are failing to beat a global equity benchmark like the S&P Global 1200 or the MSCI World, which is very, very similar. And it's not a once-off. We see this across the board with the S&P 500 numbers as well. So I'm just going to take you across the globe now to Europe and show you some numbers there as well on the next slide. It's a similar story. The European fund managers in euros is the top line. It shows over 5 and 10 years between 94.9 and 98% roughly underperformed the same index. And those operating in pounds were also 90% of the time over these longer periods underperforming. Even if you go to the shorter period, year to date, that was back in 2022, we think that there's a myth of the stock picker that many people say, yeah, when there's a bear market, Anthony, how can the index guys still do well? The truth is that we've found that most of the studies, the academic studies by many Nobel laureates, show that the cash component of active managers, which should go sky high in a bear market, doesn't reflect that. They don't all move to cash so that they can actually outperform the index. And typically, over both bull and bear markets, this cost advantage gives index funds really an unfair head start. I'll just go to one or two more slides, Eugene, and happy to take some questions. This is the home turf of the American market, the S&P 500, and even there, the smartest guys from the Harvards and Oxfords and other places, over 10 years, 90% are failing to beat the index. That's the 10-year for the S&P 500. We've also shown you the mid-cap and the small cap there. You could say, Anthony, why are the numbers so atrocious? 25, 30 years ago, Eugene, there were less CFAs out there. There were less analysts. Some people would argue that information was shared a little bit more freely on the golf course back in the day. So maybe guys had a bit of an upper hand if they were good golfers, if you get my drift. And I guess my point here is that it's become incredibly difficult over the last 15 to 20 years with all the new regulations where companies reporting has to be public. They can't, release information privately to individual fund managers. So they can't play favorites. It's become incredibly difficult over the last 15 to 20 years to consistently outperform. So these numbers have been progressively getting worse for active fund managers. Certainly in the US, where indexing is now an established fact, almost 50% of mutual fund flows on an annual basis are going into indexing in the States. In fact, as of last year, up to 60% of fund flows came into the index space. So again, we're saying one should have a balanced approach using some indexing and some active. I'm not here to say one is better than the other, but we've seen that it's very hard to consistently pick the star fund managers. So we see that last year, the stock pickers myth was shown up again because the majority of the guys last year, again, underperformed on the active side. Just to summarize then, bull markets or bear markets, it doesn't actually favor an active manager necessarily. Indexing by its nature is broad and it's more diversified. It's typically sometimes 10 to 20 times more diversification in the index. So for 37 basis points at a low cost, you're essentially getting the entire global developed stock market in the MSCI world for a very, very low fee. Some people would say, Anthony, it's sort of a brain dead offering. Just put a part of your core portfolio in there. It'll bring down the average IFA's average cost for his portfolio. And we see, I'm sure there are DFMs and others who are also increasingly following the lead of the UK and the US, where they will use indexing as a blended tool with other active fund managers. And with that, I just want to thank everybody for your support over the last 9-10 months. It's been very reassuring despite the tough markets we're in. And I'm very happy to take some questions as well.